Welcome back to the channel. Today we're diving into one of the most important and timeless books ever written on investing, The Intelligent Investor by Benjamin Graham. Warren Buffett calls it by far the best book on investing ever written, and for good reason. In the next 10 minutes, we're going to break down the key ideas, the biggest lessons, who this book is for, and how you can actually apply its wisdom in today's markets. And at the end, I'll share my final verdict. Let's jump in. Before we get into the book, it's important to talk about Benjamin Graham. Graham was a professor at Columbia Business School, the father of value investing, and the mentor to Warren Buffett. His entire career centered around teaching investors how to avoid mistakes, think rationally, and focus on long-term results instead of speculation. Sources: Graham, Benjamin, The Intelligent Investor, HarperCollins. Buffett, Warren, The Super Investors of Graham and Doddsville, 1984. A lot of people think The Intelligent Investor is a how-to-pick stocks book, but the truth? It's actually a book about how to think about investing. Graham teaches mental models, not hot stock picks. The core of the book focuses on avoiding emotional mistakes, understanding risk, buying assets at a discount, building a margin of safety, never confusing speculation with investment. These ideas are more relevant today than ever. Lesson 1: Investment versus speculation. Graham says the biggest danger to any investor is thinking they're investing when they're actually speculating. Speculation is short-term, emotional, and unpredictable. Investment is long-term, rational, and backed by analysis. Graham doesn't say speculation is evil. He just says you need to treat it like gambling and never let gambling escape into your long-term portfolio. Source: Graham, Benjamin, The Intelligent Investor, chapters 1 through 2. Lesson 2: The margin of safety. This is the most famous idea in the book. A margin of safety means buying stocks or assets at a price that gives you room for error. Think of it like driving over a bridge that can hold 30 tons. Even if your truck weighs 5 tons, you want that extra room. In investing, that means buying undervalued companies, paying below intrinsic value, and assuming you will sometimes be wrong. Source: Graham, The Intelligent Investor, chapter 20. Lesson 3: Mr. Market. This is one of the most brilliant analogies in investing. Graham describes the stock market as a person named Mr. Market. Every day he shows up emotional, euphoric one moment, depressed the next, and offers to buy or sell shares at different prices. Your job is not to take his mood swings seriously. Your job is simply to take good opportunities when they appear. This teaches patience, discipline, and emotional control. Source: Graham, The Intelligent Investor, chapter 8. Lesson 4: Defensive versus enterprising investors. Graham says there are two types of investors. One, the defensive investor, wants simplicity, prefers low effort, uses diversified portfolios or index funds, avoids speculation. Two, the enterprising investor, willing to do research, hunts for bargains, looks for undervalued stocks, needs discipline and time. Neither one is better, both work, but you need to be honest about which one you are. Source: Graham, The Intelligent Investor, chapters 4 to 7. However, Lesson 5: Market fluctuations are not your enemy. Instead of fearing volatility, Graham says you should use it to your advantage. Volatility is what creates opportunities. If prices never dropped, nothing would ever go on sale. This lesson is extremely important in today's world, where daily price swings scare many investors out of long-term positions. Source: Graham, The Intelligent Investor, chapter 8. Section 4: How this applies today. Even though the book was written in 1949, the principles are timeless. Here's how you can apply it now. Avoid hype stocks and FOMO trading. Focus on fundamentals, not headlines. Use dollar-cost averaging as a defensive investor. Look for undervalued companies if you want to be enterprising. Keep emotions out of the portfolio. Use index funds if you don't want to analyze stocks. Warren Buffett still applies Graham's ideas today, just in a more modern, qualitative way. Sources: Warren Buffett Annual Letters. Graham, The Intelligent Investor, revised edition by Jason Zweig. However, Section 5. What I loved about the book. Here are the strongest points. It teaches discipline instead of quick wins. It gives a long-term mindset. It protects beginners from major mistakes. The margin of safety principle is life-changing. Jason Zweig's commentary in the newer editions makes it easier to understand. Section 6. What could be better? The book can be dense, especially chapters 8 and 20. Some concepts are from a much older era of finance. If you're new to investing, it may feel overwhelming, but it's worth taking the time to understand. Section 7. Who should read this book? Read this book if you want to become a long-term investor, want to avoid emotional mistakes, want a foundation that actually works, want to build wealth safely over time, aren't looking for a get-rich-quick guide. Avoid it if you want hype, high-risk trading, or fast entertainment. This book is about wisdom, not thrills. Final verdict. The Intelligent Investor remains the greatest book ever written on investing, not because it tells you which stocks to buy, but because it teaches you how to think, how to avoid losing money, and how to stay rational in an irrational market. If you can master the ideas in this book, you'll be miles ahead of the average investor. Thanks for watching. If you enjoyed this breakdown, hit that like button, subscribe for more deep dives, and let me know in the comments which book you want reviewed next. See you in the next video.